Okay, Troy White with Hoodoo Financial, and as we're still speaking on preparation to become an investor. So as we are preparing to invest, there are still some important terms that relate directly to your financial freedom that we need to go over. Liability. What is a liability? A liability is a loan and or other obligation you have to pay. So a loan is obviously an obligation. Someone let you have the use of funds with an agreement that you will pay them back at a later date. So you are liable for that money that they loaned you. You got to give back what they loaned you. Well, all liabilities don't come in the form of loan. So a liability is something that you have to pay. So for us as individuals, our energy bill, our water bill, our rent, our mortgage, those things are liabilities that we have. Now those liabilities may be offset with an asset, but they don't have to be. But you usually have a liability because there's something you received in return. Basically, you have this liability because you received something of value ahead of a requirement to pay it. That's basically what a liability is. Return on investment. So this is why we invest. We need a return on our investment. So this is referred to as a ROI. ROI, return on investment. This is the performance measure that helps investors compare the rate of return offered by one investment over some other investment. ROI is calculated by dividing the investment's financial yield by its cost. The result is expressed as a percentage or ratio. So that's our ROI. Another thing I want to cover are the types of investments. Now, this is a pretty well-rounded list, but you probably can't come up with more. There are as many investments there are more types of investments that exist in the world. Here are the basics that you're going to come across. Savings account. And a savings account is basically a pot to hold your money in because you intend to save it. It's not an account that is meant for funds to come in and out of quickly, but it is not an investment account. It is an account to store your money. They're not going to pay you much. There may be some stated rate that you receive on the funds in there, but it's relatively zero. Certificate of deposit, a CD. So this is it's an investment. Basically, what you do is you promise some sort of a bank or some financial entity. You give them X amount of dollars, and they give you a promissory note that we call a certificate. The certificate is to recognize that you have deposited funds with them. And this certificate lists the terms of this loan that you have deposited with them. And the terms are they will give you X amount of interest for you to store your money with them for X amount of time. And that's basically all it is. So it's a place to store your money. Usually it's for a time horizon that is longer than your savings account, but shorter than an investment account. So when you consider the time horizon, meaning how long do I want my funds tied up? So for a savings account, you're saving money for some sort of goal where we're going on a trip to Universal Studios in less than a year. That's what you would have a savings account for. And then let's say I had an extra $10,000. I'm not really ready to invest it because I don't know when I'm going to need these funds or why I need to invest them, but I don't want to let the money sit in my savings account earning me nothing. So I I get a CD for just 10,000, and this is called a 2-year CD. I just get it for 2 years. I lock it up for two years. And so for 2 years, you're going to pay me X% return. It'll be something low, but it'll be higher than that savings. Now, annuities. Annuities are, an annuity is an insurance product. Annuity is a way to insure your money. You are familiar with the fact that we insure our homes, our cars, and our property. Well, your money is a physical asset as well. So an annuity insures that money. So it is an investment that ensures that you will not go down, but part of that insurance you're paying for a guarantee that it will go up some and a guarantee that it will not go down. So guarantees cost you money. So that guarantee is paid to you in an interest rate. But when I say it costs you, it's meaning it's not going to give you a higher return. So in terms of the levels of account, in the time horizon and the safety, the time horizon, safety, and account type, those all kind of line up with your risk tolerance and the need for this investment. So in an annuity, you would have, this may be a long-term account, that these funds that you might want to guarantee for a long term. So that's because, let's say you have $100,000 and you have other investments, you got your 401k and you're doing other things, but you got this 100 G's and you're trying to ensure that this money is going to be there for you. It's not going to go down. It's not going to go up astronomically, but I do want to guarantee that I'm going to have some growth on these funds. So that's the reason you would put these monies into an annuity. Individual stocks. That's an investment that relies on your expertise, or the expertise of the advisor, stockbroker, money manager, asset manager that you're working with. Is when you invest in a stock, you are buying a slice of a company, and you are speculating that this company will go up in value, and therefore my slice will get bigger. It's really that simple. And I use the word speculate, but in fact, I don't want you speculating. I want you to buy this stock for a reason. And the reason is because you have determined, based on your analysis, that this company will go up. Now, it might be that you feel this company will go up 10 years from now. Well, your investment time horizon better be beyond 10 years, right? So you're going to have a strategy within those 10 years as well for that individual stock. But fundamentally, a stock, you buy a share and you hope for that share value to go up. You buy it for $10, you want it to go up to $15. Mutual funds. Mutual funds are similar to stocks, but you buy one share of this fund, you buy a net asset value of this fund, and you are buying into a group of stocks. So a mutual fund can consist of 5, 10, 20, or 100 stocks. And instead of buying one, you buy multiple. Commodities. A commodity is is a good. It's so. For instance, it's like like oranges and wheat, corn. These are commodities. Oil. So you buy this. You can buy in on commodities, but fundamentally commodities. The commodities market is intended for circumstances. Let me lay out a type of a circumstance. I mean, you as an individual can invest in commodities. It's not my expertise. I wouldn't even help you on it. I give you some information on it, but I can't help you with that. What commodities are about is here's a for instance. Unless you're a company, you want to do this, I can help you do this. So let's say you are an airline. And I'm not saying you have to be a major airline. Let's say you are a charter. Let's say you're a charter airline company. You charter private jets. This is very, very possible. You charter private jets, and these private jets are owned by individuals, and individual millionaires own these jets, where your company charters you have a service that uses, just like Uber. Any jet that's idle, you charter these jets for other passengers, and they buy tickets, and you lease the jet, and you're making money on the gap in between there. Well, part of your business model is, obviously flying jets. You're going to need fuel. So when fuel costs are up, that means you're going to lose money. So how do you operate your business when fuel prices go up? So it's possible for the fuel prices to be so high today that the tickets on this air flight that you sold last month are now in the red because the fuel is too high today. So what companies like your airline would do is enter the commodities market, the futures market, and buy commodities at a price now for the future. So you would buy the oil today, so you won't have to be beholden to the ups and downs of the fuel costs throughout the year. So that's where the commodities market goes in. And maybe companies that are just you have a need for millions of apples or something like that. Just buy it in the commodities market. All right. Exchange traded funds, ETFs and mutual funds are fundamentally the same thing, but ETFs trade more like a stock. I mentioned mutual funds have an NAV, net asset value, whereas exchange traded funds have a price, just like a stock price, but they consist of multiple stocks within one ETF. So when I buy this one ETF, I buy all them stocks that are within it. So it is like another bucket that holds stocks in it. You buy that bucket, or you buy a slice of that bucket, then you bought a slice of all of those stocks. Bonds are essentially loans. When you buy a bond, you made a loan to the bond issuer. So if the bond issuer is a municipality, so for instance, I am in Oakland. This is Alameda County. So Alameda County might issue a bond to fix all the roads. They need to, right? So if I buy one of those bonds, then I just loaned Alameda County $1,000 to help fix all those roads. Alameda County is going to pay me back principal and interest on that bond. So on whatever the time schedule, payment schedule, but it's probably semi-annually. So twice a year, they're going to pay me my interest, and they'll pay the maturity at the end. So some bonds pay principal and interest. some bonds pay interest, and they pay you your principal back at maturity. Real estate. You know what real estate is physical property, land property, right? Buildings. And as an investor, we can invest in real estate. Now, we can invest in real estate in many different ways. And I'm gonna try to briefly, I'll go into those ways. The ways you can invest in real estate: you can fix and flip property, right? You can buy and hold property. You can wholesale property, and you can be a single family residence, buy the house that you're going to live in. So those are the 4 fundamental methods of investing. But within those 4, there's an endless array of what ifs and possibilities on how you can acquire the investment. But real estate, the attractive thing about real estate is that it allows you to use leverage. And so for a mere down payment, which you can also finagle on different ways on how to get the down payment. But for a mere down payment, you could buy a property that is way more valuable. And over time, as the payments are made on this property, I mean, you gain equity in the property, but throughout the entire time, you are the individual that has the use and control of the property. So this leverage gives you a unique position in when it comes to real estate. Also, real estate, you can also invest in REITs, which is real estate investment trusts. That's a great way to invest in real estate and you do that similar to investing in stocks and bonds. Currency, you can invest in currencies. Now, currency is, I won't go too deep into currencies, but essentially, as you know, every country has a different kind of currency. And you can buy those currencies. Basically, what you are doing is just exchanging dollars for a peso, exchanging dollars for a yen, for a baht, for a euro, whatever. And you are using your judgment, your speculation, whatever it is, assuming that the value of their currency will go up. And basically buy low, sell high. It's still the same thing. So what you have heard a lot about, probably a lot mentioned, is cryptocurrencies. And cryptocurrencies are the same thing as euros, pesos, yens. You know, those are just currencies. It's just another form of currency, but it's a digital currency. And they operate the same. You know, the concepts are the same on how they come and how, but cryptocurrencies are actually have more value embedded in the currency than dollars. Dollars is all about trust. They could print another dollar and just tell you it's worth something, right? So, but you can't do that with a cryptocurrency. So I won't dive deeper into that right now, but essentially, those are types of investments.